So what exactly is an annuity? How does it work? And is it actually an investment? And if it is an investment, is it a good one or a trash investment? Now, overall, I am not a gambling person, but everything in the money world is in reality is kind of like a gamble. When you put money in the stock market, you're gambling that your stocks are actually going to go up. Now, not in a gamble in the sense of like, I hope they go up. No, you understand what an investment is, what you're putting your money into, but overall, it is still a gamble in a way, but the overall idea is you want to put the odds in your favor. Now, the same thing goes with an annuity. What exactly is it? Well, an annuity is, in simple terms, is a contract. Between who? Between you and the insurance company. And what are you guys agreeing to? Well, you are agreeing to pay them a series of payments or a lump sum of money in exchange for a series of payments or a lump sum of money indefinitely. And you might say, well, that sounds redundant. Why would I give them X amount of money to get X amount of money back? Well, the answer is it's not that simple, okay? There's a gamble happening here. And I love this because if you understand what you're actually doing, you can actually win. But most people don't because they think an annuity is an investment, but in reality, it is not. An annuity is actually an insurance policy. Although they might have different annuities that actually allow you to invest your money, no, it is still an insurance policy. And I'll show you why by the end of this video. Now, as always, guys, like this video and top out also subscribe and hit the bell so you get notified. For the next 3 days or 4 days or so, I will be talking more about annuities, like the different types and the ones I recommend and so on, all right? And how exactly to use them so you never have to worry about money again. So make sure you subscribe so you keep up to date with all those videos that'll be coming out this week. Now, here are the overall basics. So again, okay, you are agreeing with an insurance company to give them a lump sum or a series of payments in exchange for a lump sum or a series of payments indefinitely, usually, or a certain amount of time, depending on the contract and how you actually do business with them. But here's an example to put things into perspective. Now, let's say you're actually 65 years old, okay? You just turned 65, you're about to retire, you've been doing things well, and you saved up a whopping $500,000. That is a lot of money, right? 500K is a lot of money no matter how you actually slice it. But let's say you don't want to work anymore and you also want to keep making what you used to make, which was about like 50K a year. Now, this basically means that if you spend 50K every single year from your 500K, well, in reality, it will take you about 10 years to actually run out of money. So in 10 years, now you're 75, you don't have 500K, and you don't really have any money. You might have, for example, a pension, some social security, and that's basically about it. But it might not be enough. So how do you actually make sure you never run out of money or have to worry about your income actually going down? Well, the answer is actually you enter into an annuity. So the annuity is this. You're going to enter into a contract with the insurance company. You're going to tell them, hey, I'm willing to give you $500,000. And in exchange, they're usually going to give you about $2,400 on average, depending. Now, that's basically, when you calculate it, well, I'm going to get $2,400 every single month indefinitely until I basically die. That's the idea, right? That basically means that every single year, the insurance company is going to pay me about $28,800. Now, here's something you really want to pay attention to. This basically means when you grab this number and you divide it by your $500,000, okay, that's basically multiplied by 100 to get the percentage. That basically gives you a 5.76% return. Not really return, but a withdrawal rate in reality. So you give them 500K in a return, they're giving you like 5.76% of your money every single year. That basically means you will be getting paid more money than you would just by using the 4% rule, which is standard rule when it comes to retirement and taking money out of your portfolio. But the idea is that until you pass away, they're willing to pay you $28,000 every single year. Now, that basically means that if you actually live past 18 years, you will be getting more than 500K. So that's when things get tricky, okay? The idea is not, for example, hey, Tommy, so this basically means that if I outlive this thing, if I live, for example, I'm 65, I live until I'm 95 years old, right? That's like 30 years. That basically means that in 30 years multiplied by $28,800, that basically means I can get basically $864,000, the insurance company is actually going to lose? The answer is no. Again, they're not going to lose. And this is not really one of those deals. The deal is not, I want the insurance company to lose by me living longer. That's not what the deal is. They're not going to lose whatsoever, because overall, when you hand them that $500K, they instantly have, for example, investments available that can pay them like 10%, 12%, usually like a lot more than what they're actually paying you. So automatically, by having that money on hand, they're able to earn money on it a lot sooner. But your entire deal is not to worry about that. Your entire deal is to worry that, hey, until I basically die, I know I'm going to be getting paid this $2,400 every single month, and I don't have to worry about losing this income. That is what you're actually doing. That's why it's an insurance policy against your income, to ensure that you actually make that money forever. It is not an investment where you're trying to outlive everything to make a good return, because in reality, this would actually be an awful return. To just get, for example, this much money in 30 years is actually very terrible. It's not good whatsoever. So there are some questions that you probably might be wondering about. Tommy, what about taxes? What about mortality risk? Okay, what about inflation? All these things matter, because $2,400 today and $2,400 every so month, 30 years from now, is not actually going to be the same. Well, first, taxes. You will have to pay taxes, but some of them actually allow you to grow your money tax-free. More on that later. 2, mortality risk. Mortality risk and longevity risk are different. Longevity risk basically means it's the risk of you outliving your savings. Like saying, for example, I have $500K, I spend $50K a year, in 10 years I run out, but I live an extra 20 years. That is the longevity risk. The mortality risk is basically, I got this policy with the insurance company, right? And now it's been 2 years and I just died. Well, that kind of sucks, right? Gave him a bunch of money. I didn't even get any money out of it in reality. I just got, for example, like 28,000 times 2. That's about like what, like $56,000, like $56,000. That's all I got out of it. Okay, so I basically lost a bunch of money. The insurance company made a bunch of money. So that's actually not true, like completely, because with some policies, they will agree to pass those payments on to your beneficiaries, like either it's your spouse or whoever you agree to it. But again, you have to read the contract and come into agreement with them about all the details. So there are these details, but they're not that much to actually worry about. Again, think about it as an insurance policy and not, for example, an investment. It is a terrible investment. Now, overall, not all annuities are going to be, for example, I'm going to give them a lump sum and then I'm going to get a series of payments. Some are actually, if you don't actually have a lump sum, you could agree to pay them a series of payments for 20 years, 30 years, and then at the end, that series of payments is going to accumulate to a lump sum. And they will actually give you that money as a lump sum, or for example, they will agree to actually pay you a series of payments. So my point is, okay, don't think that, well, you're saying I have to save up $500K to then do this. No, you could actually pay them a series of payments early on in your entire like age, right? So you're in your 30s, in your 40s, in your 20s, pay them on these series of payments, and when you turn 65, they will start to pay you a series of payments or give you a lump sum. Now, you have different types of annuities, and I won't go into all of them right now. You have, for example, deferred annuities, you have fixed annuities, you have variable annuities. So the idea is very simple. A deferred annuity is one that actually grows tax-free. A fixed one, they actually agree to pay you a fixed amount of money on the money you're actually giving them. So it's like a guaranteed amount of interest you're actually going to earn. And then a variable allows you to put that money into investments you actually care about, like mutual funds, and it could actually grow at a higher rate. That's the idea, but they still make money via fees and a bunch of stuff. And there are more details that I won't go into detail here, but here's one question I actually want to answer before I tell you, do I recommend this or do I not recommend this? And the question is this: Tommy, who exactly is this for? This is for the person that is like in their, they're like older, or the thing about being older, and they want to worry about, for example, what if I actually run out of money in retirement? And that's actually not what you want. So by doing this, you actually guarantee that, hey, no matter how much money I spend, I'm going to be just fine. The goal is not to say I'm going to give this insurance company all of my money to guarantee me this income. No, the goal is to say I'm going to give them part of my money to actually guarantee this part of my income and then use the rest of my money to actually live a better life in a way in your retirement days. So overall, what do I actually recommend and how would I personally do this? Well, the answer is this, okay? If I had, let's say I was 65 years old, I have a paid off home, because remember, you have to assume these things also and work towards these goals too. I'm 65 years old, I have a paid off home, I have no debt whatsoever, and my cost of living is fairly low. It's like $2,500. So again, I'm not paying shelter costs, I'm not paying a car payment, none of this stuff, okay? Everything's paid off. Now, that basically means that if I retire with $1 million, okay? Well, if I grab 250 grand and gave it to this insurance company, usually that will guarantee me an income of about $1,000 per month. If I grab the other $750K and I invested it and I took out, for example, 4% every single year, that would guarantee me, in a sense, there are no guarantees, by the way, none. That would basically get me a potential amount of about like $2,500 per month. I'm not including taxes. That basically means I'm getting $2,500 from my investments, $1,500 from basically $1,000 from the insurance company. That's basically $3,500, and I only spend $2,500. So I have room in there to say, well, if my investments go down, I don't have to worry because I have this money coming in right here that's actually going to come in no matter what. It's the guaranteed portion. So this basically means I can have a lot more peace of mind. But I would never, for example, buy an annuity as an investment or buy an annuity to say, well, it's growing tax free, so it's going to save me. But no, because you have retirement accounts that actually do that already. So it's like, okay, it's an insurance policy, but it's not an investment. Would I personally buy an annuity? The answer is yes. If I'm a lot older and I don't feel comfortable with my investments and I worry about like losing my income, then yeah, it might make sense. But I wouldn't put all my money into an annuity whatsoever because there is that mortality risk. And there is another risk that a lot of people don't actually talk about. And I'm going to talk about it right now before this video actually ends and I run out of time. And the answer is, there is a risk, okay? Let's say you are 65 years old and you have all this money and you basically want to make sure you don't run out of money. Now, let's say you live until you're 100. You're 65 plus 5 plus 30, that's 35 years more of life. And you have all this money. And the question is, how do I make sure that, I have money set aside for my family and all this stuff, so the rest of the money is actually mine? Well, how do I make sure that when I die, I actually die with zero money? Because if you use the 4% rule on the 750K, you won't run out of money. Like, that money will keep growing and growing and growing. And the only way you run out of money is basically like in like 33 years usually. That's like the average. So over time, when you actually pass away, you will leave a bunch of money behind. And that's not actually what you want in that sense, right? So the idea is, how do you ensure that you actually die with zero? And I have a video on that coming out pretty soon, but that's what you actually worry about, okay? That's why you want this insurance policy, because this way you can spend a lot more than 4%. You can spend like 5% or 7%, right? And make sure that when you actually retire, right, you don't worry about like run out of money whatsoever. But guys, that's basically it for annuities. And again, if someone asks you and you think about it, it's just this, okay? I entered into a contract with an insurance company. I'll give them a lump sum or a series of payments in exchange for a lump sum or a series of payments indefinitely. Why would I do this? Because I want to guarantee I'm going to receive this lump sum, or I want to guarantee I'm going to receive this payments every single month for the rest of my life and not worry about not having that income anymore. That is the what it is. That is the why, and the how you do it is you go out there and find the best company out there. I might make a video about which ones are actually the best and which ones I recommend the most. All right, thanks for watching. As always, like, subscribe, hit the bell so you get notified, and peace out. Up here, another video. Over here is my face. As always, peace.